Guys, Apple just reported they beat on both earnings per share and revenue. They were expected to do $1.51 in earnings. They did $1.53, which is actually an increase from last year when the estimates were for a decrease. Revenue is expected to come in at 90.6 billion, which is a decline of 4.5%, but it came in at 90.8 billion. So still a decline, but a narrower one. They're up to about 180 right now, about 4% after hours. Guys, everybody was watching this. They're going to have a call soon, and they're going to really explain the future of what they see out there for iPhone sales. If you remember, everybody was talking about iPhone sales in China slowing down. Now, I'm recording this video in an airport, but that's our dedication to getting you guys very quick reactions to the news. I also recorded a separate part to this video earlier today. So if you like this kind of content, we record 4 or 5 videos a day where we react to news, both economic and stock earnings, etc. So do me a favor, subscribe to the channel if that interests you. So guys, as I'll explain later in the video, you've got to remember, Apple is a huge company that generates $100+ billion a year in free cash flow. You cannot expect them to grow at huge leaps. Even if you go look at analyst estimates on our site, they're only calling for 3 to 5% revenue growth. Why? It's ginormous. How are you going to get the 10 to 20% growth in revenue? You're not going to. But Apple's the kind of company where if you buy it at the right value and they allocate their capital properly, you can make good money. They also announced an increase to their dividend. So as these companies like Apple that are more mature, that don't have reinvestment opportunities, and the stock might still be a little healthy on the high side, one way they're doing that, giving money back to investors, is through a dividend. For those of you who love dividends, don't get too excited. You're getting double taxed. Be that as it may, what I'm more interested in seeing is, as this bull market starts to weed out, Apple will definitely be one of the biggest to fall. And what are they going to do with their cash? Are they going to buy back shares? And they just announced a $110 billion expansion to their stock repurchase, which is about 3% of their stock out there. Now, again, everybody's going to be excited by that, but you're watching our channel because you want to learn the truth. The truth is, not all stock repurchases are the same. And stock repurchases at high levels are value destroyers. Stock repurchases at low price levels relative to value are value creators. That's extremely important for you to understand and know. So guys, some China information. They got 16.4 billion in iPhone sales, which was lower than last year of 17.6, I believe. But again, it beat expectations of 16.3. As you know, I don't make investment decisions based on what's reported on quarterly earnings. Do I still love hearing them? Absolutely. It's a lot of fun. But the key here that we're trying to teach, the process we're trying to teach, is to sit there and take the information, but look at it from a long-term perspective. Are they still doing the things they need to do? And Apple can't grow forever at leaps and bounds, but a slow grower still has value. The question is, what is that value to you? That's part of our process. So guys, watch this next part where I recorded earlier.
Apple's an incredible business, but just like other companies, they're experiencing some headwinds. It's just proof. This is a great learning lesson for Apple. Apple was unstoppable for the longest time. Apple is a wonderful company, but it's one of the laggers of the Magnificent Seven. It's down about 10% this year so far. It's actually within 5% of a 52-week low. Now, Apple gained a lot of attention because Warren Buffett's been buying it, and he's also been doing a great job of talking to Tim Cook about proper capital allocation. So if you're new to the channel, why don't you do me a favor? If you like news updates, if you like earnings releases that happen very quickly, subscribe to our channel. We get it done extremely quickly because we know what we're talking about and we love talking about these things. But capital allocation is one of the most important jobs of a CEO. I would argue the most important job. We all think CEOs should be these suave guys who are marketing and sales. No. A lot of money comes into the company. It's their job to determine what's done with it. Apple is huge. They generated $105 billion last year in free cash flow. What do you possibly do with that kind of cash? How are they going to move the needle? So what's most important is, what are they going to do with that $105 billion? They've got headwinds right now. China slowdown. How are their iPhone sales? But look at China. China has that effect of Starbucks. It affects all these companies because China has 1.6 billion people and a fast-growing middle class. They're becoming more of a consumer society. Just to show you as a comparison, China's GDP is about 38 or 40% consumer consumption. In the US, we're at like 70%. So they still have a lot more growth to go. The average person in China makes $12,000, $13,000 a year. We make like 70 here. It's a very big difference. China is not our foe. We have to sit there and realize that a growing world is better. Even if our slice of the pie gets smaller, if the pie is getting bigger, we will still grow. But Apple sells a lot in China. China also wants to regulate things a little bit more. So there are those headwinds, don't get me wrong. And China is a big area of growth for a lot of companies out there. But a lot of people would look at a company's recent performance and say if it's a good company or a bad company. That's not the way I want you to look at things. Stock, company, separate things. The company will drive the stock price. In the short run, stocks are a voting machine. In the long run, they're a weighing machine. You have to sit there and say, if you buy the company at the right price, if the business gets better, they can drive that value. Look at Apple. Apple is a company that will probably generate the most of its returns for the investors, not by growing their free cash flow, but by buying back their shares at the right time. That's what I really hope Warren Buffett's focusing on with Tim Cook. Tim, if your stock falls more, you need to buy more shares. Why? Because buying back shares at a cheap price adds a lot of shareholder value. How does that work? Well, guys, let's say you own a company. Let's say there's a company with 10 shares outstanding and you own one of them. You own 10% of the business. If they buy back 2 of the shares, there are now 8 shares outstanding. You still own 1, but now you own 12.5% of the business. But it's extremely important that when they buy back those shares, they're buying them at a good price. They're still investing their capital into something. It's still an investment. Apple absolutely will have a hard time being the big growth company it was in the past. Let's say they even figure out, look at this, they exited cars. Why? They realize how capital intensive the business is, and they're the ones with the capital. And 2, how many cars have to sell to really add a lot of numbers to their revenue that really are substantial numbers that make sense? That's the problem with Apple. They are so big, it's going to be hard to move that needle. But as the world GDP grows, as they get more and more people using their products, becoming more part of their life, they're going to do well. They're probably going to grow at 3 to 5% a year, and that's okay. That's great, because if they do the smart job of taking advantage of people's disdain for lack of growth, then the stock price will become cheaper and they can buy back more shares. So if this makes sense to you and you want to control your emotions better and have all the tools to make better decisions, click the link below, $7 for 7 days. Guys, we limit the number of spots every day. If you don't get in, they sell out pretty early. You'll be on a wait list. Now, there are ways to get ahead of the wait list, but just save yourself the time. It's only $7. Go click the link, sign up now.